Kevon O'Leary really likes dividend stocks, and he's got good reasons, but how has he been so successful with it? In this video, we'll break down Kevon O'Leary's strategies for you and John. We'll look at what O'Leary thinks about them and the reasons behind his preference, with exclusive snippets from O'Leary's own interviews, providing a glimpse into the strategies of a financial powerhouse. But before showing you all that, let's set the stage for why Kevon O'Leary's words count in tons. O'Leary has carved a niche as a financial guru, captivating audiences on Shark Tank. His journey in the investment world is marked by a blend of bold decisions and strategic foresight, making him a respected figure in the business community. What sets O'Leary apart is his unwavering emphasis on dividends, a building block to his investment philosophy. This focus on dividend-yielding stocks isn't just a preference, but a testament to his belief in stable long-term returns, and this strategy has paid him on numerous investments. In an interview, we hear directly from Kevon O'Leary explaining why dividend stocks are so attractive to him, especially in the current market environment.
Do you like them in particular in this current environment of a big sell-off?
I like them a lot in this current environment. In fact, they're starting to outperform because at the end of the day, when you start thinking about the success we had in technology for such a long run, they're the infinite long asset. They pay no dividends. They're trading at extremely high P's. They're not necessarily bad stocks, but they tend to really have violent corrections as they are right now. On the other hand, you take a really boring balance sheet like a Chevron or a Pfizer or an AT&T. Boring as hell, extremely strong cash flows, pay out a significant dividend yield, significantly higher than the S&P SEC yield. So you can get almost 100 basis points more with these stocks. And they're the ones I tend to favor in times like this because they pay you to wait and you don't know when the bottom's going to be. In fact, that's on days like today, that's what I buy. Now, you know I love big indexes. I design my own. Today is an OUSA day. That's an index which is chock full of boring as hell, monster balance sheet, big succulent cash flow companies that tended to be out of favor for the last couple of years. And all of a sudden, people love cash flow again. And so do I. It makes me feel warm and fuzzy every quarter when I get that dividend.
From this snippet, Kevon O'Leary really highlights why he likes dividend stocks so much. He prefers companies that might seem dull but are actually very stable, like Chevron, Pfizer, and AT&T. These companies might not be the most exciting, but they are reliable, making good money and regularly paying dividends. O'Leary believes these steady features are very important, especially when the market gets rough. O'Leary's way of thinking is quite different from those who chase after fast-growing companies that don't pay dividends. He admits that tech stocks have done well in the past, but also notes that they can lose value quickly. Dividend stocks, on the other hand, are like a safety net. They offer a steady income and some security when the market is unpredictable. He also talks about how strong companies, the ones with solid finances, tend to stay more stable when the economy is shaky. These kinds of stocks, which give out regular dividends, don't usually drop in value as much as others. This makes them a key part of a diverse investment portfolio, acting like a shield against big ups and downs in the market, as he further explains.
It's all about the balance sheet and the quality of the balance sheet, because what happens with these stocks when you have violent corrections as we're having now, remember, Wilf, it's been a long time since we started to have violent corrections. When you see stocks down 10% in one day or sectors down 3 and 4 and 5%, it's been years before we've really seen that, and now we're starting to have it. And the reason I love stocks that have really strong balance sheets with strong cash flows and distributions to them is they tend to correct less. So on a mark-to-market basis, when I'm looking at my overall portfolio, these are the anchor positions. These are the ones that tend to help me outperform during periods of extreme volatility. They're boring, but they have their place in your portfolio. You know, when people say to me, oh, I'm never going to buy an old boring stock like a Chevron or a Pfizer or a Roche, those are the ones that you love on days like today. And that's why they should always be there.
The key takeaway from this is how important a company's financial health is, especially when the market is up and down. Kevon believes that companies with strong finances are better at handling tough economic times and their stock prices don't drop as much. This stability is really valuable, especially when other stocks might be losing value quickly. O'Leary likes to invest in what he calls boring stocks. These are stocks from companies that have been around for a while and have strong, steady finances. They might not be exciting, but they bring a sense of safety with their regular cash flow and consistent dividends. They're predictable and don't get affected too much by market changes, which makes them an important part of a diverse investment plan. They balance out the more risky stocks. His approach shows that he's careful but smart about investing. O'Leary thinks these boring stocks are important not just because they're doing well now, but because they protect your investments from big market swings. For him, the real value of an investment is how stable it is over time and how well it can handle tough times. O'Leary's advice highlights a basic rule in investing: focus on the basics. By looking at the core parts of a company, like its financial health, investors can make choices that are more about long-term safety than quick gains. This might not seem as exciting as going after the fast-growing stocks, but it gives a kind of security and steadiness that's super important to keep your money safe in the long run. So, dividend stocks are the way to go when the market falls, but what about when Treasury yields rise? With bond yields so high, does that worry Kevon O'Leary as a holder of dividend stocks? Here's Kevon's take on this.
Here's my comeback to that. Go back in history and look at periods when economic activity and low unemployment have forced the Fed to move and up rates. You do get a correction like we're having now, but then you go to the companies that are increasing cash flows and increasing their dividends during that period, like the boring ones I'm talking about, and they continue to perform even in a rising rate environment. The reason the rates are going up now is the Fed has no choice but to actually deal with the fact that we have extremely low unemployment, we've had really strong earnings, and the economy, particularly the small cap companies that I invest in all over America, we're having our best year ever.
Rising Treasury yields can make bonds more appealing, and it can be a challenge for dividend stocks. But O'Leary is not worried. He believes that companies with strong cash flow and the ability to increase dividends can do well even when interest rates go up. He thinks these companies are strong and can handle changes in the economy. O'Leary's approach highlights an important aspect of investing: understanding the broader economic context. He recognizes that economic factors, such as low unemployment and policy decisions by the Federal Reserve, play a significant role in influencing market dynamics. This recognition allows him to navigate the complex interplay between stocks and bonds, particularly in a rising rate environment. The idea here is not just about choosing dividend stocks in isolation, but understanding how they fit into the larger economic picture. O'Leary's analysis suggests that even when bond yields are attractive, there remains a strong case for dividend stocks, especially those backed by robust financial health and consistent cash flows. His perspective acknowledges the competition from bonds, but also underscores the enduring value of well-chosen dividend stocks. O'Leary's insights are particularly relevant in the current economic environment, where policy changes and market shifts are frequent. By focusing on companies with the strength to sustain and grow their dividends, investors can create portfolios that are not only resilient, but also adaptable to changing economic conditions. It's a strategy that balances the need for immediate returns with the necessity of long-term stability, offering a comprehensive approach to investing in uncertain times. Moving forward, we shift our attention to a different facet of Kevon O'Leary's investment world: his foray into the ETF business, specifically the creation of OUShares. How did it get created, and what are the rules behind this new ETF business he's launched?
It's a solution for me personally, for my family trust. You know, I have been a big fan of using ETFs, and I thought, well, it could be, in a trust situation, very good. My mandate's very simple. In '97, after I sold the learning company, I created a series of trusts to do a few things within my family. When I was young, my mother decided to cut me off after I finished education. I didn't believe she would do it, but she did. She had this little philosophy. She said that the dead bird under the nest is the one that never learned how to fly. And I get what she meant now, because that's what happened. She said, you got to go make your own fortune, and you know, if you can do it. So what I've decided is to structure trusts that do this. They basically provide for children from birth to the last day of education, and then they get nothing after that. But it also takes care of their issue. When they have children, it'll take care of their birth to the end of education. So it's got to be multi-generational. So this trust in '97 was structured so it would be 51% or 50% equity, 50% fixed income. With the equity side, I used to use active managers, and this has been around decades now. And what I would find, there's nothing wrong with them, there's some great managers out there, and I've used many, but style drift creeps in. And so I have, from time to time, have to make changes. What happens when I'm gone? That's what I'm worried about. When I'm not here to do that, that's when I started looking at ETFs, because ETFs are rule-based indices. There's no style drift. And so my covenants are very simple. My trust has to pay out 5%. And I'm telling you this because the creation of O shares was to solve this problem that I'm telling you about. Every year I got to pay out 5%. I learned years ago, and this is just a fascinating, one of the things in life that it just comes from a unique experience. My mother used to take a third of her paycheck and put it into large cap dividend paying stocks and corporate credit back in the early 60s. And when she died, this portfolio had existed for 50 years. And as an executive, the first time I got to look at it, she'd hidden it from both of her husbands. It was amazing. If dividend paying stocks and corporate credits over 50 years, you can't find an index that beats that. And so when I started to do some research, I found out one interesting fact that changed my investment philosophy forever. Over the last 40 years, 71% of the market's returns came from dividends, not capital appreciation. So rule one for me is I'll never own a stock that doesn't pay a dividend, ever. Number two, diversification really matters. So I never want to own more than 5% in any one name, and that really works when you go through periods like 08, 09, where you have volatility in sectors. And number three, when you start to look at capital for multi-generations, you want preservation. So I thought I'd go to the ETF market to solve for it, and I found out something very interesting that I think others have found out recently as well. The first generation of ETFs are market cap weighted indices. So over time, when companies grow their market cap, they become an inordinately large piece of the index. And if I have a covenant of 5% market cap weight in any one name, most of these ETFs I can't use because you get 4 or 5 names represent 40, 50, 60% of the index. So I went to the FTSE Russell guys and said, look, my rules are simple. Can you give me a new index that meets my 5% market cap weighting, 20% in sector, but above all, lower vol, and I want 50% more yield from the index than the generic index? Can you design something like that for me? I have a fair amount of capital put to work. I thought that these rules would be of interest to other investors. That was the genesis of O shares. We created something new for the ETF market. It's a new generation.
The key takeaways here are setting up a system that keeps money safe and aims for steady long-term growth. When O'Leary picks stocks for the O shares ETFs, he follows a special rule to make sure the investment is spread out. He doesn't let any one stock or business area take up too much of the fund. Each stock can only be 5% of the total, and each business area is no more than 20%. This helps lower the risk and stops the fund from depending too much on any one part of the market. Also, O'Leary wants these ETFs to give back more money than usual. He's looking for a 50% higher return than what you'd typically get. This shows how much he focuses on stocks that pay dividends because he wants regular income from these investments. The interview shows how carefully O'Leary plans his investments. He likes a balanced mix of different stocks that pay dividends, showing that he knows a lot about the market and how to make money over time. This approach is good for both cautious and more adventurous investors, offering a smart way to make money in the complicated world of investing. O'Leary underscores the centrality of free cash flow in his investment decisions. He firmly believes that the primary value of a stock lies in its ability to generate cash consistently. This focus on cash flow is not just a preference, but a stringent rule for O'Leary. He steadfastly avoids stocks that don't pay dividends, viewing them as speculative rather than genuine investments. In this video, we discussed Kevon O'Leary and his love for dividend stocks. But he's not alone. Investment mogul Warren Buffett also made his riches from dividend stocks. Click the video on the screen. It'll help you find the fastest way to reach $2,800 per month.